All right, welcome back to the Kansas City Commercial Real Estate Market Pulse with back-to-back episodes this week, and we are here with a new deal spotlight, joined by Mitch Case. Mitch, how you doing today?
I'm doing well today, man. I appreciate it.
Fantastic. It is another beautiful day here in Kansas City, Missouri, and we are excited to talk about the multifamily market and a specific deal in Kansas City. Before we do that, I do want to make sure that people know that they can ask questions live here. So we are monitoring this on YouTube and on LinkedIn. So please do give us your questions, and we will try to do our best to answer them specifically for you. So very excited for this. Lots of people been looking forward to this episode. So Charles and Moore and Heather, thank you all for tuning in. We appreciate it most definitely. So definitely drop us your questions and comments that you have. Before we kind of get into this specific property, I think it's important to note that right now is a really interesting time for commercial real estate, especially multifamily, which we've talked about in the past being the first in, first out. So if you haven't, a couple episodes ago, I don't remember the actual episode number, Mitch and I broke down all of the multifamily listings that were live here in Kansas City. That was before we recently dropped our Q3 2025 Kansas City and national commercial real estate market update. So you can find that on our LinkedIn. You can find that in the comments of many of our posts, as well as joining our newsletter over at MWCREadvisors.com, or just go click that little button underneath my name and you can get to our LinkedIn newsletter as well. But a couple things that came out of that research that we had done was there have been about $41 billion of multifamily transactions in 2025. Mitch, do you know the average cap rate for those sales?
I don't.
Take a guess.
You got to be sub 6.
Oh yeah, it's sub 6 for sure. Give me a number.
5.25. 5.
Okay, that's pretty good. Pretty good guess. From the 929 deals and 41 billion, right, that has been transacted. You guys can do the math on that, right? Those are big deals. Okay, the average cap rate of those deals 5.04%. That's a slight dip from the 2024 national average of 5.24% on the cap rate. That tells us, or tells me, three different things, right? That the bid-ask gap is, and then that spread is tightening finally, right? The sellers are starting to realize and meet that market, and buyers are starting to compete for deals again. However, it is happening in tier one markets and in tier one properties. Typically, when uncertainty, right, which we have seen for the last 2 years, Blackstone called the bottom of the market in late 2023, there's a flight to quality because the quality is what people can underwrite. So we've seen two huge trends. And remember that the trend is your friend, right? So the number one trend was that these big funds, Blackstone being the largest, stopped doing portfolio deals and they focused on single asset deals that they could underwrite. And the second trend was tier one markets and tier one properties, so class A properties. And so I think that is important to remember because once they set the comps, then private investors and regional funds and private equity groups and smaller institutions can come in and start making bets. And so Kansas City, being not a tier one market, it's definitely getting a lot of attention nationally, and the fundamentals have been very strong, as we have notated multiple times on our show here. Kansas City is not a tier one market, and so we're going to lag some of those tier one markets in regards to transaction volume and pricing, right? Okay, so I think it's important to kind of keep that in mind as you're thinking about making your investment decisions. The second thing that I really wanted to kind of focus on was that, the average, so just from an average, from what I can find for the whole year, average multifamily cap rates anywhere from 5.04%, right? Those are big big deals, but not every deal is being done by Blackstone, all the way up to 5.9%. All right, depending on that market and the asset quality. But the real story is not the average, it's the spread. The institutional capital has shifted hard towards 2020 plus newer Class A vintage stabilized occupancy and those single asset deals, because during uncertain times, clarity beats the complexity. So if you have one property, you have one market, you have one operating story, you can have a clean read on your yield and you have a clear path to your exit. So there's a lot less noise, and there's no project level blind spots, right? So, and there's also no deferred maintenance. It's just pure underwriting. So we took this, what we're presenting here today. And if you want that information, make sure to go check out the newsletter that dropped today on LinkedIn. If you don't have that newsletter, just drop us a note. We'll get you a PDF of it or a link to be able to go find that. It was I think it was a fantastic research piece that we put out. So I had all kinds of research analysts working on that deal for sure. So it was very good. I was thinking it really helps people understand when you ask how's commercial real estate doing, it answers that question really well. To see $125 billion of real estate transacting in Q3 gives me a lot of confidence that continued transaction volume increases will happen. 42 billion of that happened in the last month of that quarter. So we're seeing that momentum, and we can talk at lengths about why all of that. But we just listed an 18 unit 2020 Class A new build multifamily property in a top performing submarket. This deal is the Brighton Crossing, 18 units. It's stabilized, fully occupied. It has modern finishes. It has institutional style management. We'll get into that as well. Strong rent roll, demonstrated, the renewal velocity. It's got clear value protection from limited new supply in this immediate trade area. And that's exactly the type and profile of deal that's trading right now. And as Mitch and I have started to work launching this project, in less than 2 weeks, we've got 25 or 30 CAs signed and having conversations with groups. And so if you have a 1031 exchange, this is a perfect property for you to evaluate, specifically because you have the ability to manage this from afar, because the current owner is in Michigan. And I can tell you that they have taken very few trips to Kansas City to come see that property. And if you're watching, I'm putting the number up on the screen. So, and that number is 0. So they've been able to manage it effectively for 5 years from afar. So if you're looking for a property to be able to do that, here's one that is Class A stabilized here for you to do that. It has predictable cash flow, got modern construction, low operational risk. It's got a clean underwriting story. So that's what type of deals are kind of trading right now. Mitch, before I let you kind of get into the overview of the project, sure. what I would like to do is, we had a wonderful video, drone video kind of put together for this deal. So if my computer will allow me to do so, I'm going to pull that up on the screen and get that going. But while I'm doing that, I spouted off a lot of data and information in regards to the multifamily market. If you have any questions about that, please do drop them down. But Mitch, what is your take? What is your read? You're a multifamily investor. You're working on this project. You just heard all of that data. What stood out to you?
Yeah, I think the biggest thing was, most individuals that are getting into the investment side of things tend to kind of stick to that idea of mailbox money. And this is one of those scenarios where the turnover, when it happens, is quick to fill. The stabilization of it being 100% occupied continuously is massive. It being a 2020 build, your maintenance line item is going to be extremely low. This is one of those scenarios where if you can get the right debt on this, it will literally just be that mailbox money for the foreseeable future. And so those individuals, when I'm looking at this from an investment side of things, it's one of those where, maybe there's not a ton of value add in the immediate, but this is one that we could just hold on to and just let it cash flow, and then, figure out what our exit plan is down the road. So that's what sticks out to me when I look at this from a multifamily investment perspective.
Absolutely. 100%. Well, guys, bear with me as I get this launched here for us to be able to evaluate. Let's see if I can get this up on the screen, just so you guys can get a picture of this beautiful property. All right. Mitch, are you seeing this yet?
I am not seeing anything on my end right now.
Okay.
But while you're pulling that up, I can kind of go ahead and do the breakdown on kind of how this is mixed. So this is a scenario where you're going to have a mix between single bedroom and studios in this. It looks like it's up right now, Logan. Are you ready to hit play? All right, go ahead.
Yeah, let's get this rocking just so you guys can get an idea of what we're looking for here. There we go. Look at that beauty, right? Very good work. Very good work on that front. Love that. And I think it does a really good job of showing the area and the construction and the type of units that we've got there. Okay. Well, now I'm going to stop sharing that because we don't need to know anything about the frame TV art gallery wallpapers. And then we'll get over here back to our presentation for the day. If my computer would just keep up, right? Like, just got to keep up here. All right, here we go. All right, let's get into it, Mitch. So we've talked about the multifamily market, just nationally. We've talked about what's trading and why. And now let's get into the property at hand here. So you've seen a video of the property now, and now we're kind of moving on to show you a little bit more. And here's what we're going to be covering. We got an introduction. We've got the asset, the financials, some sale comparables, some rent comparables, and a market overview for you. We will drop this into the comment section. If you guys want to find out more information about this property, you can email myself or Mitch, Logan or Mitch at mwcreadvisors.com. And while Mitch is presenting, I will go to Crexy and I will pull the link for you to go find out more information, evaluate the financials, the rent rolls, everything that we have available in our due diligence vault. Just got to go sign that CA, and we will be in touch. So, Mitch, I'm going to let you kind of take it away here. Let me get over to the property overview here for us.
Yeah. So, Brighton Crossing, as Logan mentioned, is an 18-unit multifamily property that's going to consist of a mix between single beds and studios. The current layout is 12 single beds and 6. Yeah, my math is right there. 6 studio apartments. The asking price is going to be $2.8 million, which averages out at about $155,000 per door. That's going to put us in at a cap rate for current NOI on that property at right at 5.9%. I believe we have that NOI. The current NOI is right around $164,000, $165,000 in that mid 160 range. So biggest thing, again, to hit on is really the 2020 build, where your maintenance is going to be significantly reduced just due to how new this property is.
Absolutely. I think the other thing that I'll mention is, if you're not familiar with Kansas City, just in particular, Kansas City is a market that is leading the national rent growth around 3.1% annually, and which creates an opportunity, right? It's an investment opportunity with immediate value add potential just from a rent appreciation standpoint, right? And so I think that that's fantastic, because as people are evaluating, it's like, look, there isn't a ton of value add to be harvested on this project. However, if you can get the right debt that Mitch mentioned previously, and you can work to continue to capture those rent increases, there is some upside on that. But we want to be very clear. This is a stabilized, occupied 2020 build. So if you're looking for a big value add opportunity, this likely probably is not the right move. But if you are looking for a coupon and something that's really easy to manage, this can definitely do this. MGC, I think, is doing a great job managing this whole community, right? And so I think they have a great opportunity to continue on the management and the leasing side of this business and this property. But I think that the other thing that we'll just touch on real quick is, it's pretty rare to find, a new kind of acquisition opportunity in Kansas City of this size, right? Like most of that stuff is going to be 100 plus, 150 plus
Yeah.
units. And so what we continually hear from investors is 1980s, 1990s, and newer, right? Okay, well, we've got a 2020 and newer, right? And so you have to factor that in. Risk, return, and what you are looking to accomplish, right? And so I think that's kind of we want to always be very transparent when we're doing these market pulses. If you want to come in and try to raise the rents $250 to $350, that's not happening here, right? We've got a stabilized property here, but there's only about the deliveries in Kansas City in this specific submarket, we're showing only about 861 year to date versus 2,000 in the same period of 2024. And so I think that is important to note as well as the location being in a Northland submarket. And the Northland just has been a big growth area, very good schools up there, and a place where people want to live. And so we can get into the location description here in a moment. But Mitch, sorry, I just stole the mic away from you there for a second. Is there anything you wanted to add about that?
No, I think you've got that covered.
Okay, excellent. So got a lot of good pictures. You can see the modern finishes in the interiors here. I mean, great looking cabinets. You've got your stainless steel appliances, hard surface countertops. You got your nice bathrooms as well, nice and spacious. So here's some layouts for you as well that you can take a look at. But maybe we'll speak about the area, Mitch, because Kansas City, spanning over 300 square miles, it's a big area, right? And this being north of the river is very different from the south of the river or west or east. So maybe you could talk a little bit about just like, the location.
Yeah, well, I mean, in Kansas City, you typically, if you're south of the river, you don't know anything north of the river. And if you're north, you don't know much of what's going on south of the river. But there have been a lot of changes going on just north of the river with, as you mentioned, school districts, there's development going on up there. And so the Northland is now kind of becoming a targeted location that people will actually cross over the river to go up to. One of the things that I grew up when we would come to Kansas City, or my wife was born here in Kansas City, so we were always going to Worlds of Fun or Oceans of Fun. So there's different amusement parks. There's a lot of hospitals up in that region as well. And so this is not a space in Kansas City that's kind of so far out that it's just not really entertainment or anything along those lines. This is now a booming location. And I do see a lot of people now either moving to the Northland or constantly driving up to there because there's several different entertainment districts that generate a lot of interest these days.
Yeah, most definitely. I want to take just a second and show where you can go find out more information here. You can go over to crexy.com/properties. Here's the link for you guys to be able to find this property. If you just follow Mitch or myself, you'll be able to find this very easily. But you can also type in 5711 Northeast 80th Terrace into Crexy or Brighton Crossing Apartments, and you will find it. We've had it up there only for 3 days on the market, right? Only 3 days on the market. And we have had over 25 CAs already signed. So very good market momentum on this asset class, which I think pairs up pretty well with the same type of, strategy that the bigger funds are starting to be able to, showcase and they're implementing, right? Single asset and Class A 2020 or newer. I mean, we've had over 4,000 impressions on this, 673 page views, 60 leads come in, and 16 CAs only on Crexy. So it absolutely is getting a lot of interest. And I think there's a lot of reasons for that. So let's get over to the next page here. Here's a good location for you guys that aren't necessarily familiar with this. Great highway access right off of 152 highway, right? So you're going to see where this is location. There's a lot of restaurants and retail and parks and things nearby. So good location. You can get up to the airport really quickly. You can get south down to the central business district, and you can get east and west pretty easily as well. So we like this. It kind of gives you an idea of what the units look like. We'll talk about kind of the area and the bylaws in the condo association that's involved in this here in just a second. Beautiful little water tower up here. This should be Worlds of Fun, right?
That is Worlds of Fun, yeah.
There's our Country Club Plaza. Beautiful pictures, Liberty Memorial, all the good stuff. So let's get into the financials on this deal, Mitch. I mean, we have 100% occupied rent roll on this project. And from a per square foot basis, you mentioned we've got 12 one beds and we have 6 studios in this property. So those range anywhere from 497 square feet all the way up to 731 square feet. So the 1 bedroom, 1 bath, you're going to have 2 different variations. One of those square footage is going to be 650 square feet, and the other one will be right around 730 square feet. And the studios are just under 500 square feet. So from a per square foot, rental standpoint, we're ranging anywhere from $1.50 all the way up to $1.93. So that's kind of gives you an idea of what that rent roll looks like. I do think that there is going to be some opportunities to continue to increase these rents, right? I mean, 3%, 3.1% starts to make a meaningful meaningful dent in the NOI. So we're sitting right around $165,000 to $170,000 on the NOI right now. If you do, and if you are interested, we do have insurance quotes, and we also have lender quotes in. So that is in our data vault. So if you want more information on insurance and the lending side of things, and they're very attractive, we have that available here for you as well. Anything on the unit mix summary and the rent roll that you wanted to kind of touch on, Mitch?
No, I don't. I think it's pretty straightforward when it comes down to just kind of the layout with that. I will say some of the conversations that I have had is when they're looking at that overview or the pictures, they're trying to figure out how is it possible to get 18 units in that square foot in that floor plan there. A lot of those, what I believe is the setup is you're going to have 2 single beds in the front, 2 single beds in the back, and then 2 of the studios in the middle. And so you're going to have 6 per 3. There's 3 floors on that one, so 6 per floor. And they've got them tightly covered in there. So just to let people know as they're kind of looking at that and evaluating it, it's kind of the layout for those.
Absolutely. Thank you. I appreciate that. So, currently, and we'll tell the story about kind of how we got to around 229,000. As you evaluate the financials, we have a really strong T3, T4 now. We're going to be updating everybody with the October numbers here very soon. But, the property earlier in this year, we did have some rent roll turnover. And so the owner did take some time and they kind of made those units ready. And you'll see that in the financials. We had some vacancy back in, I think it was March, April, and May. And so that has been taken care of now. So it is fully occupied now. And I believe the average, monthly rent roll is up to around $19,000 per month. So that's how we kind of get to this $229,000 of the rental revenue, right? 0% vacant right now on the pro forma. We're holding that right around 4 to 5%. So you're going to see kind of the effective multifamily rental revenue here in our gross operating income with all the different fees and the other income items that we can be happy to talk to you about. We have a gross operating income around $243,000 on this property. Again, the expenses are quite low just in regards to this deal because of the vintage of the property. And so that kind of leads us with a total expenses of around $80,000 right now. Happy to walk through that with you line item by line item. What we were able to do is we annualized the expenses for 2025 that we could. And then we really took a look at where were the outliers in regards to some of those months that had heavier make-readies. And then we just took a weighted average of those and came up with some good figures here. And I think you'll find that your underwriting should be pretty in line with us. But if you have any questions around those expenses or things like that, we'd be happy to talk with you about that. Obviously, insurance is going to go up. Taxes are going to go up. But this has been reassessed, and insurance and taxes have gone up here recently. So to what extent we can help you with in understanding that. But that gives us a net operating income around $164,000 for this property. Okay, so this just kind of breaks down the income and expenses, the chart, right? So you can kind of see where those expenses are, right? The property taxes being a big expense, on this deal. But this kind of just breaks down those different line items and it visualizes it in a different way for you guys to take a look at. All right, so if you are able to get some of the debt that we've talked about, we're really working with investors looking at 60 to 65% leverage on this property. I think that's what you're going to need to hit your debt service coverage ratio. So again, if you have a lot of equity, a 1031 exchange really is a great opportunity for you. That first year, you're looking at somewhere around $40,000 worth of cash flow on your property. So if you're a cash flow investor, you can be pretty confident that 37 to 45,000 in those first 2 years is kind of what you can expect. And then as rents continue to increase, obviously we're going to get up to $55,000 on the cash flow. Year 5, what we're showing is around $61,000 worth of cash flow after your debt service for the property. Now, this might be a perfect property also if you didn't want to put any debt on it. You wanted to buy this thing cash, right? Well, you would be able to have anywhere between $160,000 to $180,000 on the cash flow side of things if you bought this property cash. Okay, so that's a good way to kind of think about. If I go buy 18 units, 2020, low management, low maintenance. What can I put in my pocket every single year if I buy this thing cash? Somewhere around $160,000. That can be pretty meaningful for folks. So if you're looking to buy a cash property, this also fits that profile pretty well. All right. The loan amount that we do have is right around 66% in here. It puts the debt service coverage ratio about 1.29, or the loan amount about $1.8 million. And this would be a Freddie Mac or Fannie Mae loan, probably Freddie Mac, small balance loan, that you can go and look at the data vault to be able to find some of the quotes that we've already put together in here. So we just kind of transcribed what we had from a lender into our hypothetical financing here. Maybe you have a better relationship and you have a strong balance sheet that you can get better terms. If so, that's only going to help your scenario on the cash flow side of things. Like Mitch mentioned, we're valuing this right around $2.8 million. And so you are able to come in and buy a brand new property well below replacement, costs, about $155,000 per door in a great location, and really low maintenance and management on the side of things. So I think that's a good overview of the property, Mitch. Let's get to some questions that we've got. If you would like all of this underwriting, just reach out to Mitch or myself. We have a full offering memorandum that includes this in a flipbook style, a PDF style, a link style, and you have the financials available and rent roll all in the data vault. So feel free to reach out to us about that. One big question that we've had, Mitch, is around the bylaws, since this was developed in 2020 in a larger community, a master plan community that included apartments and included condos. Obviously, a condo association needed to be put in place, but we've done some, and we have the bylaws available for you to review in the data vault as well. But we reviewed the Brighton Crossing Association bylaws and wanted to try to create kind of a clear summary as it relates to the apartment buildings in the community. I think the key takeaway, and I'll let you key in on some of these things, but the key takeaway is that the association covers only the shared areas, common areas of the development, not really the apartment buildings themselves. So that means that it maintains and manages the common grounds, the community signage, the landscaping, and the general community standards, right? But the apartment buildings are owned and operated independently. Yep. So each apartment owner is responsible for their own building maintenance, roof, siding, HVAC, parking areas directly serving their building. And they also carry their own insurance for their building. So the HOA's fees cover that shared common area maintenance only, not capital improvements on the apartment structure. Mitch, why is that important for an investor?
Well, I mean, it just gives them more control of their own building. It's really going to be a way for them to not, one, have to worry about any sort of major utility issues within that complex, but as an investor, I think a lot of individuals want to make sure that they have their own control over these different scenarios. What's it going to look like from a rent perspective? And I believe that this HOA is not overbearing by any means. It's like you said initially, is really intended for the condos that are in that facility, but it is going to help them cover the major things that might happen within that complex, but it gives them the autonomy with their own building to do what they want, how they want to do that within certain means.
Yeah. Because the buildings are not subject to the HOA reserve requirements or shared, repair obligations or capital assessments, the property operates with full owner control and predictable operating expenses. That's the main point here. There's no shared oversight on leases, management decisions, or capital expenditure timing. So that provides kind of the flexibility, the autonomy, and the financial clarity that, you as the multifamily investor, generally prefer, right? And that's fundamentally different from the condo style ownership structures that you're going to see in this community, right? So that's the biggest point I think I wanted to make here just in regards to that. Again, this is a 2020 18 unit, 12 one beds, 6 studios, fully occupied Class A building here in a great submarket in Kansas City, just north of the river. If you want more information about the property, I dropped the link in. Here it is again, and we'll make sure to get it available for everyone. I think it's a great opportunity for someone who has a 1031 exchange, need to close something before the end of the year. Give us a call, right? Let's get a deal done. Let's make it happen. Absolutely. Great question. Absolutely. We always co-broker. So if you have a client that is looking for an apartment deal, we 100% will co-broker with you to make sure that makes sense and makes work. That was a big selling point with the ownership group, was to make sure that we get the biggest and broadest range of buyers. And so we always love working with other brokers in the industry. So if you've got a buyer, they need to close by the end of the year, they want a Class A deal in an apartment complex in a great location, please do reach out to Mitch. Mitch, what did I miss here?
Ooh, nothing comes to mind. I mean, we've covered a lot in there, and I think it really just kind of comes down to finding the right person that is interested in finding that stabilized cash flow. That's really what it comes down to. And as you guys have more and more questions, we can dive deeper and share everything that we've got, walk through those bylaws of the HOA to make sure that you feel comfortable with what you are purchasing and essentially getting into. But we definitely look forward to working directly with somebody or other brokers to make this happen. Absolutely. If you want more information about the Q3 2025 commercial real estate market overview, our tagline is the green flag is out. You want some of that data that we mentioned, reach out to Mitch or myself. We can get that over to you as well. You should be able to find this property everywhere. We'd love to talk with you. We do foresee offers coming in over the next 2 weeks. In regards to tours and things like that, we need a strong offer. We need a good letter of intent, somebody who has a good track record of being able to do that, because we do not want to disturb the tenants. And it's a 100% occupied building. Feel free to drive by. You can drive by the location. You can drive by the area. Definitely something that you can do on a regular basis. No problem with that. But if you want to reach out to Mitch or myself, have a conversation about this deal, go through the underwriting line by line, we'd be happy to do so. We like to keep our deal spotlights right around 30 minutes. So we're going to end this today. Back-to-back episodes this week of the Kansas City Commercial Real Estate Market Pulse. Thank you all for tuning in to another episode. Mitch, appreciate you always being here. Thanks for having me, bud. All right. We'll see you guys next week. Thank you so much.